Okay, looks like we can get started just about noon. So really honored to have Bill Poole with us today, speak about monetary policy of very important issues. Bill, of course, was president of the St. Louis Fed for a decade. Many important accomplishments. He was I like to mention he was also on the CEA 82, 84. So it's White House stuff. And he's continuing this amazing record of research. It goes back many years, but continues. So welcome, Bill. We have a good crowd and lots of questions. I know I spoke to some of you earlier about your good questions, so we'll be in touch with you. But Bill, take it away. I know you have some slides to show people. Yeah, okay.
Okay, well, John, thanks for inviting me. I'm looking forward to the discussion here. Some of my Federal Reserve friends may react that I'm really a black hat guy here today because I'm going to say some things that are not so friendly about the Federal Reserve, even though I've spent many, many years on that payroll. So I'm actually going to put on a different hat. This is what I'm hoping will be the reaction to this presentation. My background is Chicago. When I arrived at the MBA program at the University of Chicago, I took Milton Friedman's renowned price theory course, my first semester there. George Schultz was professor there. George was the head of the PhD program, and he invited me to move from the MBA program into the PhD program, which was, I think, suited me just fine. And so I have some tremendous respect for Milton and George and many others. Jean Fama and I lived in the same married student housing apartment building. Jean and I used to babysit for each other's kids. And so certainly a lot of what I have here reflects Jean's work and understanding how financial markets work. So you've had my paper, and I want to just review very briefly the model that I have in mind. And I want to concentrate, though, on the reasons for doing things this way. So I'm obviously relying centrally on John Taylor's work. And I'm defining here to begin with what I'm calling a central Fed funds rate, CFF. This is not a rate that the Federal Reserve per se sets or manages. It's defined by this very simple equation, which John developed. I've grouped the first two terms together as a constant term because I'm proposing that this be a legislated rule and that the Federal Reserve simply be an administrator, not actually setting the federal funds rate per se. So there's a term that depends on the difference between the inflation rate and target 2%, and then an employment gap term. And I would propose the same coefficients that John used, 0.5 in both cases. So the idea is that the Fed would reset this. The Fed would simply make the calculation after the release of the consumer price index. Ordinarily, that's now the second week of each month. And so the first Friday of the month, we've usually got the employment report. Second week now, it used to be a little bit longer lag, we get CPI. So the Fed then lends unlimited amount on suitable collateral at the rate of CFF plus delta, and then banks can place reserves at the Fed and earn a rate of CFF minus delta. And for the moment, we can think of delta as being about 100 basis points. And so this is a total range of 200 basis points, and the federal funds rate is set by the market somewhere in that range, given that the banks can borrow or lend at these rates, and the banks can buy longer term treasuries, like treasury bills or 1-year notes or whatever they want. And that's what ties the current federal funds rate to the future and the expectations in the marketplace that determines these yields on longer term treasuries or other assets for that matter. So market expectations of the future define the where they think this CFF is going to go, and given the rule that determines CFF and the current one for the current week or for current month really, I'm just designating here as CFF sub-0. So it's changed once a month. Okay, so I want to emphasize that as with any economic policy, we've got an issue of both economics and politics. So this is a problem in political economy. I always like to think back to the Tax Reform Act of 1986, which I thought was a great idea. Tax all income at the same rate, no special deals for capital gains or anything. Unfortunately, President Reagan didn't even convince his own vice president. And when the older President Bush became president, he immediately passed or signed into law what we now famously call the Read My Lips tax bill, and started to gut the process of the Tax Reform Act of 1986. So we've got to get the economics right. We've got to get the politics right if this is to have any lasting value. Okay, let's go to the next slide. Okay, so tiny bit of history here, right? We're familiar with all of this. We had banking panics. I've chosen 1787. That's when the Constitution was put together. We had banking panics from time to time. 1907 led many people to say we got to do something better. So we ended up with the Federal Reserve Act. But that didn't solve the instability problem. We got the Great Depression. We've had Great Inflation 1, and now we are in Great Inflation 2. And we've got the house price bubble that I'm dating 2000 to 2006, and we got the 2008 financial crisis. So we've had a great deal of instability. Let's go to the next slide. I stopped to think about this. So life expectancy in the United States is approximately 80 years. I was born in 1937, and then 25 years after the end of the Depression, which was roughly 1940, Great Inflation 1 started, 1965. That was really the beginning. And that ended about 1981. And then 27 years later, we got the 2008 financial crisis. And then 13 years later, Great Inflation 2 started, 2021. So there's been 2 to 3 periods of disorder in every lifetime. Certainly mine, but also my father's, my kids as well. And this not counting the 12 post-World War II recessions. So the Federal Reserve does, in my view, not have a great record. And I think it's important we try to figure out what has gone wrong. Why doesn't this system work better? Next slide. We have done some things right. In particular, we have a secure currency. I don't know whether my picture is still on the screen anywhere or not. I got a $20 bill in my hand, if you can see it. So the Treasury and the Fed have done a good job in creating a robust currency that is free from counterfeiting. And it's been a long time since I ever bothered to look at a $20 bill or 100 or 50 that I got in change. The currency is very secure. Next slide. Since the Federal Reserve was founded, we've got important developments in economic theory, rational expectations, economics of information, auctions. And given that what I have in mind is an auction-like procedure for monetary policy, the theory of auctions is important here. Okay, on. The idea of private auctions has spread successfully to government. We've had great success in spectrum auctions, oil leases, other such government auctions. And some auctions are not designed to maximize revenue, but for other purposes like controlling pollution, congestion pricing, airport landing slots, stuff like that. So auctions are a very efficient way to manage the distribution of resources and to use them efficiently. Okay, go on. Now, on the politics side, there's a large literature, growing literature on the behavior of elected and appointed officials. We've got problems of the rationality of voter behavior. Voters are quite ignorant, and I think rationally ignorant. Why does it pay to make much investment in trying to understand all these issues that the federal government and other governments are handling? And we have a problem with private organizations to exploit the powers of government. And I think it's essentially impossible, I've got a question mark there, to get the government incentives right for government itself to behave in a sensible way. So we've got to figure out a way to control and limit government, including the Fed, because I believe that the Fed does not have a very good record to stand on. Next slide. Politics seems to revolve heavily around concepts of fairness. And this has been very important in our history. Rule of law, due process, these are ideas that have to do with fairness, fair treatment of our citizens. It's interesting that the Constitution has a section, powers denied to Congress. No bill of attainder, ex post facto law. That just seems a condition for fair treatment. And the Bill of Rights, it's worth reading. Go back and read. A lot of these ideas came from the Enlightenment, the philosophers of the 16th to 18th centuries. And of course, we have a lot of good philosophical updates, shall we say, as I view it. And I'm very much on the libertarian side of the philosophical debate. Okay, on to the next. We have disputes over the primacy of economic goals. What's more important than what? And with regard to the monetary policy issue, it's primarily a matter of inflation and employment goals. So what I have proposed is that we put equal weights on those two goals. The Taylor coefficient of 0.5 applied to each of the gaps. I believe that, as I just keep emphasizing, discretionary monetary policy has failed over and over and over again. Alan Greenspan was very much the exception. And I know that Milton, towards the end of his life, was asked about Alan and whether he performed better than the Friedman monetary rule, money growth rule would have. And Milton said, yes, I think that's probably right, but I don't think it's reproducible. And I think that's what we have seen. Greenspan was a rare talent. the monetary instability that we have had has produced both unemployment and inflation, and it's unfair to almost every one of us. We make decisions on the basis of expectations that are then falsified by what's going on in the labor market and with regard to prices. Okay, next. So why does the Fed fail? I've been thinking a long time about this. Why does the Fed fail? And while I was in office, I kept trying to figure out how could I write down a response or a reaction function to the information that's coming along, the news, the shocks, the new information. How can I write that down? And I've decided it's not possible to write it down. Fed knowledge is limited. There are just too many new or possibly new things that can happen. I have vivid memory of 9/11 when that came along. COVID came along, huge disturbance. Years before, the Vietnam War came along, Nixon wage and price controls, the OPEC oil embargo. All of these things were inherently unpredictable, and they were major shocks. And unfortunately, the Federal Reserve has ended up more often than not, I think, aggravating those shocks rather than offsetting or reducing the impacts. I'm also struck by the fact that the market commentary, as I read it day in and day out, is mostly about forecasting the Fed rather than forecasting the future development of employment and inflation and other things that may come along. There's so much emphasis on forecasting the Fed, and we've got a situation that is best described as interaction between the central bank and the markets. It's poker. It's not solitaire. It's not a game against the characteristics of the deck of cards. It's a game among or between intelligent agents, and that makes a huge difference. Okay, on to the next. Now, I was there in the run-up of the housing boom, house price boom. And I would urge you to take a look at the FOMC transcript and meeting materials for June 2005. We devoted an afternoon, FOMC and staff devoted an afternoon to discussing the housing situation. And one of the things that we missed, I spent a lot of time trying to understand what was going on with the GSEs, but I failed to read the rule that was published in the Federal Register, and here's the reference to it. So HUD set housing goals. It was all there for us to read, but I don't think any of us read this stuff. Or at least if we did, there was no discussion of it at our FOMC meeting. I don't remember talking with anyone about it. It was all there if we had only read what the HUD housing goals were. So these goals forced the GSEs to buy weak mortgages. And it's also true that this rule promulgated by HUD was reviewed and was approved and pushed by OMB. It was part of President Bush's ownership society. So we had Congress wanting to push the affordable mortgage goals. Bush's OMB wanted it, HUD wanted it. And what it did was to produce a financial crisis because the GSEs were able to buy these mortgages under the assumption that the GSE obligations were essentially Treasury obligations. And that's exactly what happened. Treasury bailed out the GSEs. So they created a huge amount of rotten paper, and that's what collapsed. And it wasn't just the financial institutions that collapsed because of the rotten paper, but several million households ended up with damaged credit ratings and foreclosed homes, properties. And that, I think, had a lot to do, as yet not completely understood or understood much at all, with the slow recovery of consumption as we climbed our way out of this 2008 financial crisis. There are millions of households that had damaged credit ratings that were no longer able to borrow to buy houses or consumer durables or get credit cards. And that, I think, had a lot to do with the slow recovery. Okay, I think I'm on about my last slide here. Maybe I have two more. So the question is there a way that we can bring market expertise, market forces, what we know works in terms of the pricing of assets, billions of interacting competitive players bidding for securities, changing the prices as new information comes along. I would emphasize the success that we've had in stabilizing the international monetary system through floating exchange rates, a market device, if ever there was one. And I would propose that we also move to a closely connected companion idea, banking reform through the use of subordinated notes, contingent capital. And we could then eliminate much or most detailed bank regulation. One more slide. So it's important that we not permit the perfect to be the enemy of the good. And this is a point that Milton made all the time. So here's what I think is the situation under the idea that I have thrown out there to see if it sticks. Could another Great Depression occur if the MBTR had been in effect? I think it's unlikely, although we might have run into the zero bound problem. Could another great inflation one have occurred? I don't think so, because I think the market would have understood what Arthur Burns did not understand or was unable or unwilling to do. Arthur Burns, in his Per Jacobson lecture, said we could have stopped the inflation at any time, but he didn't do it. How about great inflation too? I think the Federal Reserve had badly mismanaged the situation as we came out of the COVID crisis. So these are my answers to these questions. And if we could eliminate the practical possibility of repeats of these episodes, I think it would be enormously valuable for our society. I'll stop there.
Well, thank you very much, Bill. This is a great overview, and we have a few people who agreed to make some comments from different perspectives. I don't know if they mind if I call on them. Like Otmar, would you like to lead off, or would that be okay, or what? Otmar, I assume you're in Germany, but I don't know.
So thank you for the invitation to this fascinating talk, and to the opportunity to meet my old friend, Bill Poole. I've so much learned from him before I became a central banker, and then I was happy to be invited to many conferences when he was president at St. Louis Fed. So as liberals, I think we are all impressed, so to say, by the paper of 1936 by Simmons, Rules versus Authorities. And even as I became a central banker, when I was criticized by the monetarists in Germany that we would not strictly follow a monetary rule, I said, show me a rule, I would be glad to follow it all the time. But my experience so far that in practice it has not worked as good as when I presented these ideas to my students. So now has Bill found the magic formula, question mark? I think we all would hope he had. But my experience, or it's a typical economist's attitude, always to find problems in any proposal. So I will not talk about what I found interesting and fully go along with Bill's considerations. I just raise a number of observations. The first one is bases his proposal on rather strict economic theory. I mention only rational expectations theory. On the other hand, in his paper from 1999, he, to my mind, rightly so, denies that we have a chance to formulate an optimal monetary policy, which has been in the idea of a control theory. So I see a conflict in this because his approach is, if I understand, especially his paper of 99 right, is based on, I would say, bounded rationality. The public and the central bank have incomplete information, both. And his point is the public and the central bank has more or less the same information. My experience was when I was at the ECB and gave public speeches, people often said, we did not expect you to be so open in your policy. And my reaction was, I'm not telling any secret. You have more or less the same information as we do. You know our reaction function. You should expect what we are doing. If it is on the 1st or on the 15th of a month, or is it by 25 basis points or 50 basis points or no move, I think these are minor issues, but grosso modo, you will never be surprised what we are doing. So now Bill turns around the issue. The central bank is inferior in the judgment about the future to the public. And I think this is an interaction. Bill says the public is watching what the Fed, the central bank, is doing, and not what they have in mind, what the future would be without these actions of the central bank. So this is a complicated interaction, but more or less, I think the problem is not that the central bank has limited information, but it does not keep to its mandate. We have seen that very clearly in the Fed's case, in the ECB's case. You, John, and others have said for a long time that what these two central banks were doing was against any information. And of all the rules I have experienced in literature, only one has survived. This is the Taylor rule, but in many different formats, but more or less giving the same information. And probably the widest divergence between central bank interest rates and analysis shown by the Taylor rule is at present. John, I don't think we have seen a wider difference in the past. So on the other hand, if one would continue your work of 93, which started as a positive interpretation first and became a normative project later, so I think the same should be done first with Bill's rule. He at the end of his article, he says he would expect that application of his rule and analyzing, make a judgment on the Fed's past policy would bring evidence that his rule is superior. But I think we must first see if the rule really stands this test. Probably final point, not to be too long, is Bill's rule, to my understanding, does not make any difference if inflation is driven by a supply or by a demand shock. So would he expect the same reaction in both cases without any further analysis? And along these lines of the implementation of the rule, there are quite a number of open questions, but first I will stop here. Thank you.
Thank you, Otmar. Bill, do you want to respond to Otmar's point? Bill?
I'll say just something very, very quickly, because John, as I told you, I learn a lot more by listening than I do by talking. So I want to hear what others have to say. In terms of the supply shock versus demand, the fact is that the Federal Reserve doesn't have any control over supply. The Federal Reserve might be able to cushion some of the supply, but if the Federal Reserve allows a supply shock to accumulate into an ongoing inflation, that makes the situation worse, And I think that's what's happened this time. But I think it's also what's happened from time to time in the past. So if the Fed policy can fix the inflation problem, well, that's going to be a major advance if we can get that job done. That's my view on that.
So thank you, Bill. So Athanasios, you have I know you have a long set of comments, but go ahead, please.
Thank you, John, and it's really a pleasure to be invited here, and thank you so much, Bill. I've learned so much reading your work and listening to you over the years. And when John informed us about this seminar, I actually went back and read again yesterday your 1971 paper. You may remember that you wrote when you were at the board on rules of thumb of monetary policy. I remember Volker Wieland and I had read that when we wrote a paper on your earlier work on Taylor rules at the conference. And when I see what you're proposing right now, I see that you're proposing something that I very much agree with, that we need to encourage the Federal Reserve and other central banks to stick to policy rules and remove all of the sources of distraction and error that come from discretion that is unhelpful, along the lines of what Otmar mentioned before, that goes back several decades, Milton Friedman, Henry Simons, John Taylor, and so forth. And the question in my mind is how do we nudge the Fed and other central banks to adopt a fixed rule and convince them to do this? And here I agree with Otmar's concern that if the proposal we make is for central banks to adopt a fixed coefficient rule and put it in law and never have the possibility of changing those parameters, central banks, both at the Fed and elsewhere, will kill that proposal very easily to politicians by saying, well, we know that there is no such thing as a fixed rule that can work all the time. So reading through your paper, one example that you highlight is we could assume a constant natural rate of interest, which of course we know if we do that in any simple Taylor rule, then the inflation will be deviating from our inflation objective over time. Or assume the natural rate of employment of 4%, and we know that as the natural rate deviates from that, inflation will be higher or lower over time, and we want to avoid that. So I think an alternative way to be more convincing with central bankers, which I would hope to encourage you to put as part of the proposal, is to give policymakers the following law, the following guide. We want, in the case of the Fed, for example, the Fed to tell us what is the simple policy rule that they think best describes how policy should be conducted right now. Put that in next January's monetary policy strategy statement. Follow that within the error band that you specified. That's fine, whatever that rule they have, but also let them know that they will have the flexibility as they learn over time about more about the economy, more about whether the parameters they have picked are the best ones, the natural rate of interest, the natural unemployment, the response parameters, and so forth, to have the opportunity to change them. Because when I read your paper, I see that the simplest thing to do is to eliminate the uncertainty that is coming from the fact that policymakers are still shifting around from what their implicit policy rule is, and that creates a lot of uncertainty in markets. And this is why on the market side, we have market participants trying to forecast the Fed instead of focusing on the economy. And the Fed can actually help us a lot reducing that by telling us what the simple rule is, and then have a systematic way of adapting that rule over time as information comes. We just close by reminding you of something you wrote in 1971, which I think is great, and I would just want to take that as a starting point and then have the Fed publish that. You had in the paper a sentence that says, individual policymakers inevitably use informal rules of thumb in making decisions. Like everyone else, policymakers develop certain standard ways of reacting to standard situations. These standard reactions are not, of course, unchanging over time, but are adjusted and developed according to experience and new theoretical ideas. So what I would want in the new paper is to add that idea and say, yes, we want the Fed to be explicit about what it's doing, but also give it the opportunity in a systematic fashion in the future to revise the simple rule that they're following.
I have a much more radical view of this than Anastasios has. I do not expect that the central banks will ever walk away from the power that they have. I do not trust the central banks. It's not because I don't trust individuals. It's because I do not think that they have a task that they can master. Stuff comes along and you don't know how to deal with it. I mean, I lived 10 years trying to figure out how to respond to this, that, and the other piece of information that came down the pike. We had an excellent staff. I read and I read. So I'm convinced that we cannot outperform competitive markets. I don't think that an individual can outperform. I do not think that the individual with a staff of 500 economists can outperform the market on a consistent basis over time. So my reasoning flows very much from my view of how financial markets work, my view of the evidence from the rational expectations literature, my view from the comparison of managed mutual funds relative to index funds. That's where my view comes from. And I do not think that we can anticipate that the central banks by themselves will be able to solve this problem, because they will be subjected to political pressures that they will find they cannot resist. That's the bottom line. I think we have to have a much more radical view of what needs to be done and what can be done.
Okay, thanks, Bill. I think Peter Ireland is next, and then we have a few other people coming on. Peter?
Thanks very much, John. I have a comment and a question for Bill, but before doing that, I want to go back to the previous comments by Otmar and Athanasios. Ultimately, and I'll get to in my comment for Bill, I agree with Otmar and Athanasios that on a practical level, it's going to be a hard sell at the Fed and in Congress to have a fixed legislated rule. Now, that said, though, I would also go back to a point that Milton Friedman or Bill made, and Milton Friedman made even before Bill, the expression of, not letting the best be the enemy of the good. You adopt a fixed coefficient Taylor rule and assume a value for R star. And then over time, it turns out maybe the true R star was 25 or 50 basis points higher or lower. And so inflation for a while turns out also to be 25 or 50 basis points higher or lower. Okay, if only that were our problem now. And, the same comment applies to Milton Friedman's constant money growth rule. I mean, that's not an optimal policy in any theoretical model, but as Bill mentioned in his presentation, we would not have had the Great Depression with a constant money growth rule, probably not had the great inflation without a constant money growth rule. So yes, there might have been additional short-term volatility in other instances, but we wouldn't have had the Great Depression. So I'm a little more confident in that a fixed coefficient Taylor rule will deliver satisfactory outcomes from an economist's viewpoint than the previous commentators. But now let me come back to your ideas, Bill. I do worry that from a very practical perspective, and like you said at the outset, this is an economic problem, but it's also a political problem. Federal Reserve officials have never been willing to announce a specific monetary policy rule or make consistent reference to a rule. Even in Congress, there have always been some members, enlightened members of Congress, who have pushed the Fed to announce a specific rule. But overall, within Congress, you're always going to have debates about relative weights on employment versus inflation. And then there's another idea that my former colleague, Ed Kane, always talked about, which is the scapegoat theory. A lot of congressional leaders want to leave the Fed with discretion because it gives them the opportunity to take a backseat and criticize mistakes ex post. If you have Congress legislating a Taylor rule, then the mistakes get blamed on Congress, not on the Fed. But this brings me to my question for you. Your plan, Bill, which I like very much, has two parts. There's the Taylor rule part, the TR part, which comes from Congress, but then there's the market-based part, which simply involves cleaning up the existing corridor system and widening it to allow more market forces to work in setting short-term interest rates. I'm wondering, do you see any, and that's something that the Fed could reasonably do by itself without the help of Congress and without having to announce a specific policy rule. Do you see any advantage or any hope if we can't have a legislated rule or an announced rule? Would we simply get some benefits from cleaning up the floor system, turning it into a bona fide corridor system and widening the band?
Let me remind all of us here that Milton Friedman's famous paper on flexible exchange rates, I think, was 1951. It was not until 1971 that we got there. Ideas matter. It often takes decades for ideas to percolate and to make a difference. So that's what I'm throwing out here I think we need to work through if this idea would have capped inflation at the great inflation at 5%, instead of it going up to 10 or 11, wouldn't that have been an enormous benefit? Because not only did we bear the cost of the inflation, but then we had a very steep recession. We got both of them. And I think that's what's going to happen this time too. We're going to have a bad recession come out of this. So we will have paid very heavy costs for the mistakes that we're making right now. The Federal Reserve is making as we speak. Interest rates are still being held below the current rate of inflation. It's still advantageous for people to speed up purchases on any item that they think is going to rise faster than the rate of interest. So we've still got that in place, even as we speak today. So if the Federal Reserve had a good idea of a response function or reaction function, I'd love to hear it, but I don't think it's possible. I don't think it's possible. It's not possible because stuff comes along that is unpredictable. In dealing with COVID, did anybody try to go back to the 1918 Spanish flu and work out the data and how long it took for various things to happen? It wasn't possible. It wasn't possible. COVID, first of all, was a worse disease than the Spanish flu, but we didn't know. We didn't know. We need to find a way to bring more intelligence to bear than can be done from anyone's head or from anyone's organization. I understand that Congress would prefer to beat up on the Fed, but that's of course part of the problem. That's what has to be attacked. And we're not going to attack it if we don't do something that is different from what we've been doing. We cannot rely on the political strength of Federal Reserve leadership to solve that problem. We cannot. That's my position. We cannot. We've been through this over and over and over again. We have seen very, very experienced, knowledgeable people lead the Fed. McChesney Martin had a long, pretty successful run, but towards the end of his career, Martin ended up being heavily pressured by President Johnson. And even during the period that we might regard as being the superior performance, we had one recession after another. We had recessions, and you can count them. We had, 3 recessions in the 1950s? And it came about because the Fed stuck with interest rates, created a procyclical behavior of the money stock that was very well supported by the work of Friedman and Schwartz. And I worked on that stuff too. So the money stock was clearly procyclical, fed into the inflation process as the economy recovered from the previous trough. Then the Fed became concerned about the rate of inflation, clamped down. I think it's correct that the inflation process moves more slowly. If you look at rmeier models, I haven't done any of this recently or looked at any of this, but real activity moves first and then the inflation moves later. And so as we come out of the current inflation, real activity will contract. There's got to be some reduction in real activity to take the pressure off prices in a number of different markets. And most likely, as the Fed has said, we are going to stand the course. We're not going to reverse field until we see progress on inflation. But that's an invitation we know, I think we know, to create another recession. So we've got to do something different. We've got to bring market forces to bear and the great diversity of views and information gathering incentives that the market can bring to bear. That's my idea.
Okay. Bill, thank you. We have more questions. I see John Cochrane is next on the list, and Bob Hall, Steve Davis, David Bell. Go ahead, John.
Thanks. Bill, this is wonderful. The rest of you don't know, Bill was my boss in 1982 at the CEA and got me going in monetary economics, and thank you for that, Bill. I think the observation that most market commentaries about what the Fed's going to do is just tremendous. And if anyone under 50 is listening here or has a graduate student, scraping text data to show that is a great thesis in coming. Now, why does the Fed do what it does? I think the most important part of the rule, they say, we're not doing discretion, we're reacting to other shocks. And write down any model, precisely that's what the Fed should do. It should react to the shocks. But what I think Bill is saying in a technical language is that's not possible. You can't identify the other shocks and you don't know how to react to them if you could. So a rule is mostly, it's not what you should do, it's what you forswear I'm not going to do. And in particular, supply versus demand. The Fed and central banks don't even think in terms of supply versus demand. And they got this COVID shock completely wrong. They thought it was a demand shock when it's really a supply shock. And so what Bill is saying, and I think exactly rightly, is yes, that's optimal in the model, but don't do it. And write a rule that says you're not going to do it. The political thing that leaves out is the political demand of the Fed to feel important and be in the newspapers all the day, and its desire for institutional grandeur. You got to solve that one somehow, Bill. Let them announce the rule or somehow feel important every day. Now, the actual rule, when we Fed Taylor rules, there's a lot of persistence. The Fed does not move immediately. I don't think John Taylor himself right now is asking for 14% interest rates. The Fed moves slowly, and I think it moves slowly for a reason. There's a lot of noise in the monthly or quarterly inflation rates. So I do think if the Fed is actually, they say what they say is we're going to follow Taylor rule, but then we're going to take our sweet time. So the speed of adjustment, I do think has to be in there if you're going to legislate it. The core of the question is this delta, the size of this corridor. And here I think we are a little thinking muddy. Is it market determined or is it a pure corridor? The Fed's going to set interest rates, why not plus or minus 10 basis points? Is it market determined? Then we have to say something about setting a quantity and rationing reserves or something of the sort. I have a related proposal, which is the Fed should target the spread between indexed and non-indexed and let the interest rates rise on their own. And so I think there's a good feeling here that there should be market determination of short-term real rates, but I'm not sure that a wide corridor is the answer. Next, Bill's got to go on. What about QE? I think the answer is don't do it, but that should be part of our role because that's what central banks like to do. Bill is great in integrating financial instability with monetary instability. They are indeed one and the same. And I want to applaud this entirely, given the massive failures. Our model remains lever all you want, and our regulators are going to foresee what happens. It failed with the mortgages. It failed with Greece. It failed with COVID. It's failing right now in Europe with energy, and the bank regulators are off doing climate change. I agree entirely. I think it can be even simpler. Just lots and lots of equity is how you should raise risk capital is feasible in today's financial system. Bill wasn't deep on that, but it's important. And the last point I want to make is, however, right now we face another problem, fiscal constraints on monetary policy. We're in a situation with out of control fiscal policy and asking the Fed to pull the parking brake while the fiscal foot is on the gas. I don't think you can run any rule you want. That's not going to work. So we have to integrate the rule for the Fed with some sort of rule for fiscal policy that says when inflation gets out of control, you guys have to tighten. The Fed can't do it alone. And that has to be part of the legislated agreement, as it is really with inflation targets. Okay, that was fast. Thank you. Great, many thoughts.
Quick comment. The corridor system bounds short-run fluctuations in interest rates. However, it does not mean that the actual federal funds rate in the marketplace will be at one end or the other. The actual interest rate in the marketplace in the system that I'm proposing might well be in the middle, because that will be determined by the term structure of interest rates that connects the current week to the future. And if the future is expected to stay about in the middle, then the current interest rate is going to stay in the middle. It's not going to go to one side of the corridor or the other. The one side of the corridor or the other is the way in which you force the current number to reflect the future expectations as speculators buy or sell assets depending on their views about the future. And so I do not, in fact, that's a point that I emphasize in my paper, that the corridor system does not require that the federal funds rate actually trade at the ends, at the edges. And if the future is expected to be stable in terms of employment growth and inflation, then you might well expect the current federal funds rate to trade more or less in the middle.
So,
And incidentally, I want to emphasize, let me emphasize one other thing. I do not expect the Federal Reserve or any other central bank to want to give up its authority. The question is whether we can persuade the legislative branch to impose a new system in the interest of price and employment stability for the nation.
thank you, Bill. Bob Hall's next. Bob?
Great. Well, this is really an interesting discussion. I think it's gotten to the heart of quite a bit. Bill mentioned auctions. At Stanford, auction falls in a larger science called mechanism design. And in particular, there's a recent paper that's coming out in the Journal of Economic Literature on this entire issue that we were talking about today. It's really a good paper by Ricardo Reich and a co-author. It's available on his website, number 7 of papers of his that are works in progress. One thing you should be aware of, Bill, is that the science that surrounds the kind of rule that you're talking about emphasizes, and this goes back to work of Tom Sargent's many years ago, and that is that the mechanism makes the price level a random walk an indeterminate. There's no determinate price level. There's a determinate rate of inflation, but there is, so you can think of this in calculus terms, there's a constant of integration, which is not determined by the process. And that generally in an equilibrium setting results in there being a random walk component to the price level. And that you may or may not care about that, but you should certainly be aware of it. But in general, going back to read Ricardo's paper, it's really a must read for anyone in this area. It's got totally up to date thinking. It's 97 pages or something. I mean, it's really the last word in this area. It's terrific.
Thank you.
Very quickly on the random walk. Obviously, yes, if we can stabilize the inflation rate, the price level becomes a random walk. And the way I've thought about this in the past is I say the variance of the price level grows with the distance in the future. So, however, the uncertainty about where we're going to be 10 years from now or 20 years from now, the effect of that uncertainty should itself be discounted. And uncertainty over where we're going to be 50 years from now, apply a discount rate to it, you discount it back to the present, that uncertainty doesn't really amount to very much. And I think that if we can stabilize the inflation rate. So if the inflation rate does not have a great deal of persistence to it, then we will go a long ways towards stabilizing the real economy as well.
Thanks, Bill. Steve Davis?
Yeah, thanks, Bill. This has been a fascinating discussion. So I agree with you about the poker playing aspects of monetary policy, how that injects needless uncertainty in the economy. And I would also say diverts a lot of really intelligent people from trying to figure Fed watch when they might be doing something else that has higher social value. I agree with your diagnosis of Fed failures and why they occur and your pessimism about eliminating them. And I agree with you, the Fed will never willingly give up its power and discretion. All that said, I'm a bit concerned by the starkness and the what I'll call rigidity, maybe not the best word of your proposal. And let me try to explain why, just by starting with a small observation. If I just take the formulas and the values in your paper and accept them as, you know, how we would specify the rule. If I go back to April 2020, the unemployment rate rose about 10 percentage points from March to April 2020. So if I plug them into your formula, that means the CFF value's got to go down about 5 percentage points roughly. That's an enormous change, especially if you have tight corridors in the Fed funds rate. You have a little remark about side condition. You might want to have a side condition that says, you know, the Fed funds rate change from month to month might not be too large. I think that's an argument for a side condition. By the way, that would have put the interest rate well below, well into negative territory at that point in time. So I make this point about what your current formula implies just to highlight another point which you make in the paper, which is that, look, stuff's going to happen that is either really hard or impossible to predict. And I'm worried your implicit fallback, if the rule really runs into a situation that is causing havoc in the market, is to go back to Congress and say, well, let's get Congress to change the rule. I just think about, well, imagine trying to do that back in the hectic time period of April 2020, and to do it within the space of a few days or so. That just doesn't strike me as a very good fallback position. So I think we need to be humble, not only for the reasons you described about which fed into the inability of the Fed to accomplish its task. And one of the reasons you said was, you know, kind of our lack of perfect knowledge about how the economy works, but also about your rule. It might not work. I mean, I see a lot of good things about it, but its reliance on the market and so on. But things might happen that we don't anticipate, including failures of the rationality of market participants. I read the evidence as a little less positive on that than you do. So I'm groping for some other fallback. I don't know whether it's a sideline group of senior monetary experts who are not part of the Fed system, who can undertake proposals to modify the rule or the parameter values in an emergency by the Fed, but only with the approval of this side commission. I don't know, but I'm just a little reluctant to implement the rule in the stark way you describe, with Congress, with appeal to Congress as the only near-term fallback position.
Bill, go ahead.
If we go back to the COVID episode where unemployment was zooming up, let's remember at the same time that the inflation was also rising at that time. And so the effect on the CFF number is got some offsets here. It's not all running from the employment side. It's running also from the inflation side. Secondly, with the unlimited amount of borrowing possible at the plus delta side of the corridor, there's a great deal of built-in flexibility in the system for market institutions to handle the disturbance. Not everything has to be done by the Federal Reserve. This builds in an automatic stabilizer into the monetary and the financial system. It allows financial institutions to borrow from the Federal Reserve on good collateral, whatever they need, if they've got good collateral to make it work. And so that is built into the system. I would not say that we would want to enact a statute like this and regard it as good out to infinity. I would say, as with any other statutes, as we gain experience as how it works, then we might modify it. But I'm trying to get us off dead center from where we are now. I think we have ample experience that what we've been doing doesn't work. We've got over 100 years of experience with the Federal Reserve. And given that experience, I don't see why we should be hopeful that the future is going to be any different.
Thanks, Bill. David Papel, David?
This paper made me think about John Taylor's proposal from about a decade ago for legislative policy rule. And in that proposal, the Fed chose a rule of its choosing, which could be changed, which in accord with Athanasios was saying earlier, do that once a year in the monetary policy report, rather than put in these 5 or 6 different rules that just muddy the waters completely and mostly serve to get the idea that policy rules are sort of useless. But when you took that proposal, John's proposal, what's the enforcement mechanism? The enforcement mechanism is if you deviate from the rule, the Fed chair has to testify to Congress as to why, right? You're not forced to exactly follow the rule. Now let's look at the proposal now. And let's go back to a slightly different example. Let's look at, and again, I apologize for background noise, I can't help it. If you look at this rule now, yes, it has the 200 or 300 basis point bands, but look what would this rule have done in late 2007, early 2008? Remember, this rule's on the headline CPI. Energy prices are going through the roof, right? Tremendously through the roof. Headline CPI was going through the roof. Core CPI was not. And we would have had, even with the corridor, a really large increase in the federal funds rate, which turned out to just preceding the great financial crisis and great recession. This is a point that Ben Bernanke made in his January 2020 speech to the American Economic Association. So I think the idea of limiting discretion and limiting discretion the way John had with limiting discretion is something that would be doable. I think that to totally eliminate discretion, it's going to put the Fed in positions where it's going to want possible positions that it wants to do things that turn out that has to do things that it really doesn't want to do. And I'll just quote a phrase that was used earlier today, comparing these two. I think in this case, the perfect is the enemy of the good.
Okay, quick response on a couple of things here. Keep in mind that the inflation that I have in my model is 12 months inflation, not just month to month. So yes, if you take month to month and multiply by 12, you got a big problem. So I'm not proposing that. I think you need some smoothing. Secondly, after the cycle peak in December of 2007, unemployment started to go up. So you had the inflation indicator and the employment indicator going in opposite directions. I'd have to go back and calculate. In fact, I've sort of started this calculation with what it would actually look like. And you have to use the original release data, which you can get from the St. Louis Fed's website. And you can run this calculation and see what it actually shows. It does seem to me that what we need to do, if we're going to have discretion, that there be an emergency procedure of some sort that suspends the statutory rule of the type that we have in a number of other areas of government. So there should be some standard way we operate, and then under some emergency declaration by the president, the secretary of treasury, we can go off the statutory rule. And perhaps, by the way, even with activity by Congress, I think we sometimes underestimate the extent to which Congress can act quickly when the need for the action is demonstrated. And I think the TARP example, even though the TARP legislation was defeated the first time around, I think that's a pretty good example of Congress acting when there is an emergency circumstance that requires action. But there should be a steady state, run-of-the-mill, normal arrangement that works. And I'm still not, I would have to go back and look at the history here to decide how often we would have that emergency situation arise.
Thank you, Bill. Axel.
Yeah, thank you. Fascinating discussion. Some observations and then a proposal. If I understand it correctly, we have the discretionary camp and the rules-based camp, and Bill's proposal is really at the somewhat extreme end of the rules-based one, trying to minimize, if not to eliminate, discretion altogether. And in that context, if we have what some have proposed, an annual review, I think we're getting very right back into the problem that we have. Just think about the many years of low inflation we had. Why wouldn't some bureaucrats have said, hey, we can push unemployment much, much lower. It's not going to be a problem. And then just in early 2020, we could have had a rule where we say, okay, we push the unemployment rate down to 2%, and we're not going to care about inflation. Even if it comes up, we'll act with a lag and have some backward-looking idea going forward. And so I think if we're going to have a more radical change, we need to try to minimize in whatever way possible the ability to have that sort of discretion. And the one challenge that some have pointed out is, oh, inflation might be too volatile and so forth. And Bill just said we might need some smoothing. And indeed, I think we should probably focus on what sort of exact inflation metric with smoothing, maybe using inflation expectations, maybe a further backward-looking metric or whatever it may be we use. And then that's the proposal part of this. Why don't we just throw out the unemployment target? Didn't used to be there. Not all central banks have it. And if we have an unemployment target, we are inviting political interference. Why don't we just tell Congress that's your problem and have an inflation target and a rules-based system, have the perfect not be the enemy of the good. And I would think it will be much less subject to political interference if we have an inflation target and that's what we follow and that's the end of it.
I have only one reaction. Rather than using the word extreme, I would use the word rigorous to describe my proposal.
Yeah.
Is that fair enough?
Absolutely. Yeah.
Okay, thank you, Bill. Andy, Filardo. Andy.
Yeah, so this is, Bill, this is a great proposal. And my comment's going to be similar to David's, which is, what is the transition to get from your extreme to where we are right now? And, where could you see this being implemented in the world? I don't think the US is going to be the first one to implement this. I'm thinking of Sweden or New Zealand might be a place to go. But, my point here is going to be, I'd be more confident about this proposal if I understood the transition of how we get from what's being done today, which is maybe some lip service to a Taylor rule, maybe using the Taylor rule as a guide to a legislative rule, and really, lay out a plan where you use sort of Bayesian learning to try to bring central banks to the promised land. So should we first insist in some legislation that central banks have to do a very serious job of explaining if they have some sort of baseline rule, what are the errors, both in the short run and over long periods of time, and do this seriously, because it's not being done today, breaking things into supply factors, demand factors, domestic factors, global factors. It seems to me if this first step was taken, we might get to a place where we start aligning incentives of policymakers with the research staff, so that the staff is working effectively to kind of understand where we went wrong in thinking about the rule and where we can get better. And then from there, convincing policymakers to support such legislation. And I'll just add in, I think you need financial stability in there explicitly, not just price stability, but I'll leave it at that.
I would have to rely on experts in political science to help me understand the transition that countries have gone through as to whether they are gradual and accumulative, or whether what works best, sharp break with past practice. My sense is, and I'm not a political scientist and I'm not a historian, but my sense is, for example, we had wage and price controls during World War II, and they were simply abolished. We had fixed exchange rates, and they were abolished. Not quite overnight, because there was a sort of transitional arrangement, but they disappeared pretty quickly. And one of the dangers of any gradual effort is that you never get to the end of it. What happens is you create new vested interests that want to keep it the way it was. And so when I'm not a historian, as I emphasize, and I'm not a political scientist, but when I think about something like the American Revolution and the Constitution, think about that. That was a really radical, that was a truly radical change in governance. Truly radical. I've done a little reading about the colonial times, Gordon Wood work, but we adopted a truly radical constitution. It was a complete break. Now, there were state constitutions that provided a lot of guidance, but run a country on the basis of this agreement worked out in Philadelphia over the summer. So I think that if we're going to talk about any sort of gradual evolution, we better understand the politics of it and whether we ever get to the other end of it. Fair enough?
I'm gonna say thank you, Bill. Bob has, that's maybe the last question, Bob.
Okay, yeah, okay, fine. Here's my summary. I think that April 2020 completely ruins the idea of trying to stick to any fixed formula. First of all, let's get the facts out. The unemployment rate went to about 17% or even more if the BLS hadn't made a mistake. So unemployment went really high. And it's not the case that that inflation started. In fact, inflation declined initially on a quarterly basis. The initial response to inflation was negative, that is to say, the same direction as higher unemployment. So that by itself just kills, and very recent experience kills the idea. And I think that for better for worse, the wise man approach, which is obviously repeatedly a failure, is the best approach we have. It's like democracy. It's no good, but it's better than anything else.
I have to go back and look at the numbers, but what did the Fed actually do at that time? What the Fed did was to lower the federal funds rate from wherever it was, 3.5, something like that, down close to zero. That's what the Fed actually did. And
Yes.
I think the Fed probably also pumped a lot of additional money into the economy through purchases of government securities. That would happen automatically. That would happen automatically under the system that I outlined. So what I am not convinced, I have to go back and look at the numbers because that's obviously what's at issue here. But what I think the Fed actually did would not have been all that different from what would happen under the proposal that I threw out on the table.
But I,
Okay, well,
but I just, this is the point I was trying to make earlier. I think your proposal implies the Fed should have done at least twice as much as it did in terms of cutting the interest rate, which would have taken the interest rate well into negative territory. I'm not sure whether it would even be feasible, but I leave that.
I mean, what I said in my paper is that the Fed funds range, the extent they're plus or minus delta, the minus delta would zero out at zero. I mean, you would not go below, you can't go below zero. I mean, we've been through that, and with quantitative easing and all of that. But what I want to do, and I have actually started some of the empirical work to look at, based on the first releases of the data, look at, just calculate what this rule would have called for. And that's the next thing to get down to look at. So we're not just making guesses about what would be involved here, but we can run it off the actual data. What we can't do, what we cannot do, is to simulate what the market's response would be, because the market response that we have evidence on was a response to the monetary regime that has been in place. So how the market response would differ in a different regime is something that you could no doubt construct some simulations, but how much confidence in you would have in them, I think I would have questions about how much I would want to rely on that evidence. I think we do have a great deal of evidence, however, about how financial markets in general operate. We have a huge amount of evidence on market responses to new information. When you are watching the 8:30 release of the employment data, and you have on your screen the futures market for Dow and S&P 500, you can see the market move. You can see it move instantaneously. The market moves much, much more quickly than the Federal Reserve moves. The market moves instantaneously as the information comes in. We know that. And it moves in both directions, depending on the nature of the information. And there's a huge amount of research on that, how that has worked in the past. So I actually have started some of the empirical side of this. Just look at what the calculation would be based on the first releases of the data, rather than the series that's massaged that we have after all the changes in seasonal factors and all that. Seasonal factors are a problem because of the way the revision process works. But I think that that's the next thing. And I've got part of that work already done. And maybe in the spring, we can have another seminar and take a look at what the data show.
Okay, I think we're about out of time. This has been a fascinating discussion, which you created, Bill. I like to focus on rules, strategies, whatever you want to call it. But thank you so much for joining us and for
Thank you
answering
for having me.
questions. Yeah, it's been great. Thank you.